Assalamualaikum and good day, everybody. Welcome back to this course, Introduction to Financial Accounting and Reporting. So today we are going to continue on another chapter, that is Financial Statement Analysis. Okay, first of all, let us look on the learning objective of this course. At the end of this chapter, the student should be able to, number one, explain the objectives of financial statement analysis. Number two, describe and explain the different types of financial ratios. Number three, to calculate and interpret the main financial ratios. Finally, to explain the use of ratios in analyzing the performance of a business. Okay, recall in the previous chapter, we have learned how to prepare the financial statements that are the statement of profit or loss and the statement of financial position. So as we know, the financial statements basically report the performance of a business and its financial position for a particular period. So it only provides the snapshot of the performance and the position. After all, the financial statement can be further analyzed to help the business stakeholder to understand the overall health of the business and to evaluate the business value, especially on the risk of the business. This analysis can be done through the various use of various tools. And one of the tools that commonly used is the financial ratio. So first thing first, before we do the analysis, let us look on the objectives of doing the analysis. Number one is to identify the weaknesses as well as the strength of a business. Number two is to identify the appropriate steps or actions to overcome the weaknesses. And finally, to enable the business to improve its overall financial situation in the future. So, how are we going to do for the analysis? So, the analysis can be done through the financial ratios. So the ratio analysis is the process of determining and interpreting the numerical relationship based on financial statements. So we are going to use the information presented in the financial statement and analyze it using this financial ratio. It is the technique of interpreting of financial statements with the help of accounting ratios derived from the statement of profit or loss and the statement of financial statement. Statement of financial position. Okay, these are the three common financial ratios used in the financial statement analysis. Number one is liquidity ratio. Number two is efficiency ratio, and number three is profitability ratio. And each of these main ratio will have another ratios. Okay, for example, liquidity ratios consist of current ratio and acid test ratio, or also known as quick ratio. For the efficiency ratio, it will use inventory turnover ratio and average collection period. And as for profitability ratio, it consists of gross profit margin ratio, net profit margin ratio, and return on investment. First of all, let us look in detail what is liquidity ratio. The objective of this ratio is to measure the ability of business to meet its short-term obligations when they become due. So it will measure the ability of business to pay its short-term debts, okay, when it becomes due. Okay, the first ratio under liquidity ratio is current ratio. So this is the formula, okay. It is called current ratio because it establishes the relationship between the total current assets and total current liabilities. The objective of using current ratio is to help the users to measure the business ability to pay its current or short-term liabilities with its current or short-term asset when they become due. The ideal ratio is 2 to 1. This means that for every 1 ringgit of current liabilities, the business has 2 ringgit of its current asset to repay its 1 ringgit of liability. A current ratio which is less than 1 indicates that the business debt due in a year are greater than its asset that expected to be converted to cash within a year. So this may be alarming because this seems risky to the business as the amount of current assets to pay its current liability is less. So in other words, it says that the business has a problem to meet its short-term debts when it becomes due. Okay, another ratio is called acid test ratio. Okay, this is the formula. The acid test ratio is also known as quick ratio, where it only takes the most liquid assets, okay, to pay its current liability. So acid test ratio will only use the business most liquid asset, such as cash, bank, and accounts receivable. Okay, so this asset test ratio will measure the business ability to instantly use its most liquid asset to pay its current liability. Okay, since the company only takes its most liquid asset, therefore, the current assets here must exclude the inventories and the prepayment. Okay, since these two current assets are not easily converted into cash. Okay, as a result, the higher the ratio result indicates that the business is liquidity and healthy. Okay, while the lower the ratio result, showing that the business is likely struggling in paying its current debt, similar to the current ratio. As an example, a quick ratio of 1.5 indicates that a business has 1 ringgit and 50 cents of liquid asset to cover its 1 ringgit of liability. Where a business that has a quick ratio less than 1, it shows that it may not be able to fully pay off its current liabilities in the short term. So basically, acid test is more or less the same as the current ratio, except that under acid test ratio, it only takes the most liquid assets. Okay, next, let us look on the next ratio. That is the efficiency ratio. Okay, the objective of efficiency ratio is to measure the efficiency of a business in managing its assets to generate revenue. Okay. Under efficiency ratio, we have two ratios. They are, number 1, inventory turnover ratio. The inventory turnover ratio is a ratio showing the number of times a business can sell and replace its inventory during a given period. So it shows how frequent the business can sell its stocks within a year. Okay, so this is the formula of the inventory turnover ratio. This ratio is calculated by dividing the cost of sale by the average inventory, where the average inventory is calculating by, adding the opening inventory and the closing inventory and divided by 2. So this is how we will get the average inventory. As a result, high inventory turnover usually a sign that the sales are healthy. meaning it indicates that the business is selling its product in a timely manner. A rate of 1 or less means the business have excess inventory, and it is a sign of risk in the business cash flow since the inventory is remain in the business and unsold during the period. Okay, the next ratio in efficiency ratio is average collection period. It is also known as accounts receivable day. This ratio represents the length of time a business undertakes to collect money from its debtor or accounts receivable. As a result, the shorter the period is better as the business have better liquidity. Because if the debt are not collected on time, meaning that the business may not have enough cash resources to operate. So the shorter is better because we can have money, so it shows that it can help the business to use the money to pay for its expenses and for other operation. But if the business take longer time to collect the money from the debtor, the business might have problem in its cash flow. Okay, the last one is the profitability ratio. The objective of this ratio is to measure the performance of a business during an accounting period. So the performance can be measured using 3 different ratios. One is gross profit margin ratio. This is often shown as gross profit as percentage of net sales. So the sales here should be net sales. The gross profit here is expressed as a company net sales minus the cost of goods sold. Gross profit margin shows the amount of profit a business makes after paying off its cost of goods sold and before deducting the administrative expenses, distribution expenses, finance expenses, and other operating expenses. Basically, a higher ratio is more favorable. As an example, if the gross profit ratio is calculated to be 40%, this means that for every 100 sales generated, 60 ringgit will go to the cost of goods sold and the remaining 40 ringgit is retained and could be used to pay off the operating expenses. Okay, the next ratio is net profit margin. Net profit margin measures the amount of net profit generated by business from the sales revenue. It indicates how much each money of revenue is retained by the business after total expenses is paid off, and it helps investors to assess the efficiency of business in controlling its operating and overhead costs. As you can see, the formula is more or less the same as to gross profit, except that under gross profit, we measure the amount of gross profit upon the net sales. But for net profit, we will measure the net income. The net income here refers to the net profit. So to find the net profit, okay, we will subtract the cost of goods sold, the operating expenses, and other expenses from the net sales. And the ratio is derived by dividing the result, that is the net profit, with the net sales and convert the figure to a percentage by multiplying it by 100. Okay, similar to gross profit margin, a positive or a higher net profit margin indicates a strong financial health. A high profit margin is often an indicator of efficient operation management with low expenses and efficient pricing strategies, meaning the business may sell the product at higher selling price with a low expenses. So that's how the business may get a high profit margin. A low net profit margin reflects a poor pricing strategy and inefficient cost structure. Okay, last but not least is the return on investment. Return on investment is also called as return on capital employed, ROCE. Okay, the return on capital employed is calculated by dividing the net operating profit or EBIT. EBIT stands for earning before interest and tax. So alternatively, we will use as net profit and divided by the capital employed. So to find the capital employed is we can use, okay, the first or the second formula where to calculate the capital employed is by finding the difference between the total asset and the total current liability as per the first formula, or by adding the owner's equity and the non-current liability as per the second formula. Okay, so from the main formula, net profit divided by the capital employed, we can express the capital employed as per this formula. Number one, total asset minus total current liability, or the next formula, shareholders' equity or the owner's equity plus the long-term liability or non-current liabilities. Okay. Another important thing that we need to know on return investment is that we need to know the function of ROI or ROCE. This ratio indicates how well the business is doing in relation to the amount of money invested, or the efficiency of business in using its capital to generate profit. And usually the higher the ratio is, the better. Right. To have better understanding, let us look on this sample illustration together. Usually, the students will be given the information extracted from the trial balance or information extracted from the statement of financial position of a business. Okay, as for this example, okay, the following information is extracted from the books of Rayani Enterprise as at 31st December 2009. So these are the following balance from the books of Rayani. And please take note that it is said all sales were credit sales. So the sales amount here, 96,000, represent credit sales. Okay, since all sales were credit sale. Okay, and we have to assume that a year has the 365 days. Okay, now let us look on the requirement. You are required to calculate the following ratios based on the information above. So there are 6 ratios to be calculated here, and we are going to find the answer. And each of the ratio calculated above need to be explained because the requirement, the question requires us to comment on each of the ratio calculated above. Okay, so let us discuss on the solution together. Before we start answering the question, there are some tips that useful for the students. Number one, student must be able to understand the structure of the financial statement and how different parts of the financial statements are connected to each other. Number two, students must memorize the formula and able to explain the answer behind the formula. Finally, student must provide working for the ratio calculation. If an answer is wrong and there are no workings, then no marks will be awarded. But if the answer is wrong and workings are provided, there is a possibility that the examiners can award marks for the parts of the calculation that are correct. So please take note, it's very important for us to show the working instead of the final answer only. Okay, let us calculate the first one, that is the current ratio. So let us recall the current ratio formula, that is total current asset divided by total current liability. So from the question above, okay, we need to identify what are the current assets. If the total current asset is not given directly from the question, so we have to find by ourselves. As you can see here, let us highlight the current asset. Based on the list, okay, we can find that the current asset consists of bank, 11,200, cash, 3,800, closing inventories, that is inventories as at 31st December 2009, 9,700, accounts receivable, Okay, accounts receivable 9,000, 5,500, and that's all. So overall, we have four current assets, and for current liabilities, okay, for current liabilities, we have accounts payable 8,590 and accrued insurance 4,200. So now, let us check together the answer. Okay, right? So these are the current assets. The total is 30,200, and current liabilities, which consists of account payable and accrued expenses, 12,780. So the answer is 236 to 1. So what does it mean here is that, okay, so we have a positive value. This is the value of the current ratio. Okay, remember, the higher is better. The ideal is 2 to 1. The ideal is 2 to 1, but we have greater than 2. So it's a favorable answer. We will comment it later on. Now, let us move to the next ratio, quick ratio. So the formula of quick ratio is we will take the most liquid asset only. So how to find the most liquid asset is by subtracting the inventory and the prepayment from the total current assets. Because under current asset, we have all lists of current asset, including the most and the unlikely liquid asset. So in quick ratio, we have to identify the ability of the business to use its most liquid asset to pay its current liability. Therefore, to find the most liquid asset, we have to subtract the asset that is not liquid, that is inventory and prepayment. So, from the case, okay, we only have inventory in our question. We don't have any prepayment item. Therefore, we only minus for the closing inventory and divided with the current liabilities. And as you can see, the result is 1.6 to 1. Okay. Even though it's lower than 2, but it's still greater than 1. So it shows that the business is still able to pay its current obligation when it comes due. Okay, the next is to calculate the inventory turnover ratio. So the formula is cost of sale divided by the average inventory. So how to find the cost of sale? Let us look on the question. Okay, the cost of sale is not given. So to find the cost of sale, we have to construct, okay, the formula or the equation where the opening stock, okay, at purchases should be net purchases. So if you have any return, you have to minus for any return that is returned outwards. Okay, so we are going to take this one at purchases less return outwards, and we are going to minus the closing stock. Okay, so there are 4 items that we need to identify under cost of sale. And for the average stock, okay, for the average stock, what you do is that we will take the opening stock, okay, the opening stock plus the closing stock and divide by 2. Okay, please take note, these are the information that we are going to use in our formula. Okay, so the answer is as follows. Okay, this is the opening stock plus the purchases minus for the, okay, this is the opening stock, plus purchases, plus the return outwards, and plus, minus the return outward and minus the closing stock. So we will have the answer 41,280 and divide by the average inventory. This is the opening stock and this is the closing stock, divide by 2. So you have 8,295. So the answer is 5 times. So this shows the frequency of the business in selling its stock during the year or in replacing its stock during the year. Okay, the next ratio is accounts receivable collection period. So the formula is accounts receivable. Accounts receivable should be the net account receivable after we have minus any bad debts. And divide by the credit sales, okay, the net credit sales, and times with 365 days. Because we are going to measure how long the business takes to collect its money from its debtor within a year. So the amount of accounts receivable and credit sales, okay, can be located here. So we are looking for accounts receivable. So this is the accounts receivable and divided by the sales. Okay, the credit sales, sorry, the sales should be on net. So you have to take sales minus by the return inwards. So you have to minus this first to have the net sales. And please take note that all sales were credit sales, as mentioned in the additional information. Okay, let us look the answer together. So the account receivable is 5,500 and the net credit sales is 95,600 after we have minus the return inwards and times with 365 days. So the answer is 21 days. Okay, the next ratio is the profitability ratio. They are gross profit margin. Okay, so to find the gross profit margin ratio, we have to find the gross profit first. So to find the gross profit, since the amount is not given directly in the equation, so we have to construct this formula where the cost of sale is to be minus from the sales to derive the gross profit. And the sales from the question is, okay, this one. Okay, sales, okay, minus return inwards and minus cost of sale. So the amount of cost of sale is already calculated when we find the answer for inventory turnover ratio. So we can actually use this figure back, okay, in this calculation. See? Okay. Use this. And for the net sales, we already calculated, okay, when we calculate for this ratio. So this is the net, okay, sales. All right. So what we need to do is that we just have to simplify the ratio and the answer is 56.82%. So it shows that for every 100 ringgit of sales, okay, the business generate 56 ringgit and 82 cents of gross profit, okay, which can be used to pay off its operating expenses later on. Okay, last but not least is a net profit margin. So we just have to replace the formula to net profit and divide by the net sales times with 100. So the net profit is already given directly in the question. So you just have to take the figure directly, 18,410, okay, and divide by the net sales. The net sales is already calculated before, right? This is already calculated before, so you just have to replace in the formula. So the answer is 19.26%. Okay, basically the net profit usually lower. The result of net profit margin should be lower than the gross profit, since the net profit is the amount of revenue left from the net revenue left after we have paying all the expenses, including the operating expenses. Okay, so as for the interpretation, okay, so based on our answer in current ratio just now, we have 2.36. So this is how we interpret the result. Okay, it means that the business, that is Rayani Enterprise, has RM2.36 of its current assets to repay RM1 of its current liability. As a quick ratio, the result is 1.6. So it explains that the Rayani Enterprise has RM1.60 of its current liquid assets to repay RM1 of its current liability. Okay, please take note all these important or the key words that you need to do. Okay, so RM2.60 of current assets to repay RM1 of its current liability. Quick ratio, RM1.60 of liquid asset, okay, to repay RM1 of its current liability. So there is a difference between quick ratio and current ratio here, because current ratio we measure the current assets to pay the current liability, but for quick ratio we measure the business most liquid assets to pay its current liability. So the most liquid asset is exclude the closing stock and any prepayment. Okay, next is let us interpret the inventory turnover ratio. The business replace its inventory 5 times during the year. Or you can alternatively, we can say that Rayani Enterprise sold its stock 5 times during the year. Okay, because inventory turnover measure how the number of times that the business replace its inventory or sells its inventory. Okay, the next one is the accounts receivable. So here, the answer is 21. So it shows that the business took 21 days to collect payment of debt from its accounts receivable. Okay, next is the gross profit margin. So as I mentioned you just now, okay, we use the 100 as a basis of sale. So if you use 100 as the basis, for every RM100 of sales, the business generate a gross profit of RM56.82 before any expenses were paid. Okay, but if you use, let's say if you use RM1, okay, if you use RM1, then this one you have to convert to cent. So it will be 57 cents. 57 cents, okay, of gross profit before any expenses were paid. Okay, last but not least, the net profit margin for every RM100 of sale, the Rayani Enterprise generate a net profit of RM90.26 after the expenses were paid. Okay, that's all how the answer should be presented. Remember, for this ratio, the important thing is that you need to memorize the format and you must understand how the items in the financial statement is connected to each other, because some of the items may not provided directly in the question. For example, such as this one, gross profit, you may have to construct, okay, the equation to find the cost of sale. Okay, and last but not least, you must be able to interpret for each of the result given by each of the ratio. All right, that's all for today for this course. Okay, if you have any question, please do contact me, okay, at the platform provided. Okay, thank you.